to us
Thank you, Vani.
what you see as default rates now that the Fed has stepped in and the situation may not be as dire as it would have been if the Fed hadn't stepped in.
Yeah, I'm not going to make a prediction on default rates, but clearly, as you pointed out, it's going to be a lot lower than had initially been anticipated in late March, early April. I would maybe take a bit of a contrarian view in that I think the Fed should have been possibly more patient with some of the actions that they've taken. I know I'm on here partly because we were able to take advantage of late March and early April and the dislocations that we saw in the real estate debt markets, which worked out quite well. And I would love to be wrong about the fact that I think that there will be second and third legs down and that this will go on for a lot longer than at least the equity markets seem to be anticipating. But I would reiterate that I think that the Fed didn't allow us to come anywhere near the precipice and has potentially set up a moral hazard dynamic by essentially putting a put option on asset values to some extent.
So you referenced a trade there, Al. I'm very curious. Would you explain to us the Freddie Mac debt trade that paid off quite handsomely for you in March?
Sure. We'd been anticipating a recession for a while and have stayed quite liquid. And so in late March and early April, when mark-to-market margin dynamics came into play for many hedge funds and mortgage REITs, we were liquid and were able to quickly react and acquire Freddie Mac bonds, primarily mezzanine bonds, which essentially a very safe part of the Freddie Mac capital stack at very deep discounts because of liquidity dynamics that existed in the market at that time, and it really was kind of a 2.5 week time frame, literally from March 19th until April 3rd. And we acquired approximately $3 billion of Freddie Mac bonds during that time frame at plus or minus 30% discounts to notional value or par value.
So that was a phenomenally steep discount to par, and I'm sure you're very pleased. But is there more to go, Al?
I think there's more to go. There hasn't been more to go over the last 6 to 8 weeks. I think that the Fed stepped in and has essentially announced that they're willing to acquire, a number of different asset classes, and that has put the brakes on, let's say, distressed or highly motivated selling for the time being. I don't think that we've seen the end of this by any stretch of the imagination, although I will hasten to add that I would clearly forego fund profits to be wrong, because that would mean that the world and the pandemic is in a far better place than I expect it to be 3, 6, and 9 months from now.
Yeah, that's for sure.
But just coming back to that trade, Vani, I think part of the dynamic is that the turnaround was so rapid that we had anticipated acquiring at a discount and selling in a 1 to 3 year time frame at par, and we literally were able to sell within 3 months at par.
Wow, that is a very foreshortened trade position really there, Al. So what happens now? I mean, with this area, this one thing we're seeing contract signings come back again a little bit, not as bad as anticipated. Looks like housing, residential at least, might be holding up. But you're also in things like senior assisted living, you're in off-campus student housing, commercial real estate. What's the outlook for those areas?
We're in medical office, senior housing, and student housing. Heaviest concentration is in medical office, although we play the very high end of that sector. Medical office will be a shining star in this downturn. Very few deferral requests, very few delinquencies, very few defaults, which is exactly why we invest in that sector. The senior housing side, although hammered in the press, as you are well aware, the high end of the senior housing sector, independent and assisted living, private pay in major markets, has fared very well, and our portfolio actually has only seen about a 3% decline in occupancy with no delinquency whatsoever. We expect senior housing to emerge, I'm talking about high-end senior housing, to emerge from this pandemic stronger than prior to the pandemic, primarily because of enduring demand and significant supply constraints. And on the student housing side, while faced with obviously a challenging 2020-2021 academic year, we think that student housing will come out of this, and I'm talking about at major public universities, so brand name universities with enduring demand growth. When you look at 2021 and beyond, I think those universities will be very well positioned. And in fact, you will have not just demand for enrolling for people enrolling for the 2021 academic year, but you will definitely have some deferred demand because there are a fair number of students that will elect to defer this year and instead go to 2021. So long story short, we think that if you're at high quality properties at strong university markets, you're going to do, quite well on a longer term basis. Obviously, we're in a difficult time period at the moment.
So, Al, I know that you're not willing to give us the type of level of defaults that you're anticipating or that you've baked into some of your scenarios for your own portfolio, but what about postponements of loans, or is there any other concrete metric that you can give us that would give us some kind of an idea of the outlook for commercial real estate in general?
Well, I am willing to give you, statistics on our portfolio where we don't expect to see any defaults on the debt side. And we've underwritten on that basis. On the equity side, where we own assets, we expect to see a very quick recovery. And the housing markets overall, I think that you're going to see continued strength with pockets of weakness. But compared to 08, 09, I think, I think you're going to see fewer defaults than you saw during that time, during the 08, 09, 2010 time frame.